Welcome to today's webinar, Real Estate Trends in 2026. I hope all of you are well and ready to start. First of all, nice to have you here. But before we start, please note that there is a Q&A function just on the top of your screen. So don't hesitate to post or write any questions you may have for our experts, and we will try to answer them as best as we can. But now I want to welcome our experts today. I would start with Dr. Jan Linsin, Head of Research at CBRE Germany, bringing not only the German but the global CBRE perspective and know-how in today's meeting. We have Mark Holz, Head of Strategy and Research at Lübke Kelber, and our host Alex Grillier, CEO and co-founder at due diligence platform Drooms, or to be more precise, maybe today, real estate lifecycle platform might be the better term. But anyway, happy to have you all here and looking forward to the discussion. Hello.
Hi there.
Hello. To kick things off, Alex, you and Drooms, you have conducted a yearly report on real estate trends and covering transaction duration in the European markets for, I think, 3-4 years now. And I just wanted to quickly have a look into the findings of that report with you. Could you just walk us through the key findings?
Well, yeah, thank you, first of all, to all who are joining today. It's a pleasure to be here. And indeed, we have published again our real estate trends report, where we are measuring a couple of things. One of them is the duration of the transactions in Europe. So if I look at the trends over the years, it has become longer and longer every year. And this year, it's the first time we have seen for 2025. So it's a real estate trends report 2026, but obviously measuring the year 2025. And in 2025, it's the first time we have not seen an augmentation of the duration. So we are at roughly an average 363 days. Which is stable, is a stabilization compared to the previous year. So this is, we could say this is a good sign, but this is obviously where we will be discussing a little bit afterwards. Another thing is that beside that fact, more than 53% of the participants have the feeling that the transaction duration is taking longer and has taken longer over the last 12 months. So there's obviously a gap between the fact that we're measuring and the sentiment that is in the market. So with regards to the closing of deals, 24% of the people we have been asked are seeing a slowing probability and a dropping probability of closing a deal after a successful due diligence process, which is interesting and might be worth part of the discussion today. And then with regards to the ticket sizes, the plan for 2026 that people have, that we have been talking to, is that 36% are seeing like ticket sizes up to 20 million, which is interesting that we have like 14% of the people we have been talking to who have seen who are planning to have ticket sizes bigger than 250 million, which is large portfolios, obviously. So there seem to be the wish and the plan to put that into the market. This is, and I have to say that this is before the new wave of crisis went through the world. We might be discussing that as well. Then, with regards to the asset classes, it's like the most interesting still seem to be living and housing, then logistic infrastructure, like data centers and stuff like this are of high interest. And then one of the topics that have been mentioned a lot in the report is that the refinancing could be seen as a major issue, as well as regulation. And then still the bid-ask gap, which is still there. So this is roughly in 2 minutes what this trend says. But I can only invite everybody to download it and to read it. It's pretty interesting and provides pretty interesting insights.
Thank you, Alex. And so let's kick it off with the question you posed in the beginning. When we look at the transaction duration, which is stagnating at 363 days in Europe, and for Germany, I think we have seen a slight decline. Are those signs of a turn of trends? Could it be that the transaction market is gaining traction again? And is that a good sign, or is it not a so good sign for the real estate branch in Europe? Maybe Jan and Mark, you could jump in directly.
Sure. Yeah, I think we are at the beginning of a whole new rebound and recovery in the investment market, not only in Germany, but also in Europe. And you mentioned a stagnation of the duration. What we see in the overall investment volumes, so we had a really good Q4 last year with an outstanding investment volume in the UK market with more than 30 billion euros only in Q4, given the fact of larger platform deals and portfolio transactions. And also in Germany, we saw an investment volume of 10 billion euros in the last 3 months of last year. And even when I look at the current situation and give you prelim numbers for the Q1 26, we are heading towards 8 billion euros for all asset classes across Germany. And to put this in the context, last year we had only at the beginning of 25, we had only 7.2 billion euros for the first 3 months, and the year before only 6.3 million. So we see this gradual recovery in the market, in Germany and elsewhere in Europe.
I mean, it's about time that things change, right? Yeah. I think this has been probably the longest pause in the market that I in my career could witness. Even in 2008, after Lehman, the recovery, the transactional volume recovery was quicker. Markets repriced faster than they did now. And it's just taking longer than it did after Lehman. And Alex, just one question on your report. I'm a bit of a data guy, as you said. The transaction time is taking now like 363 days. Do you have a time in your head what the minimum per year was? Was it more like 100 days or more like 200?
It's funny that you're asking this. It was like I cannot say in earlier days because we didn't measure, but we started measuring it 5 years ago, and 5 years ago we were at 190 days. So it's like it's almost doubled, you know.
Doubled, yeah.
And yeah, it almost doubled. It's like so this is really a trend that we have seen. It has been coming, you know, gradually and then stronger, you know. And but now we have that dip, you know. It's like now it's stagnated, and even as Jasper correctly said, in Germany it's going a little bit down. What doesn't mean that everything is closing. That is another topic. It's like only because the due diligence phases are taking shorter, not everything is closing at the end. That's another finding that we had, which is unfortunate.
Yeah,
but you also mentioned, Alex, that you started in 5 years ago, right? So within this 5 years, you have 5 major external shocks, so to say: the pandemic, then the aggression of the Russians in the Ukraine and the ongoing war there, and since end of February, the Iran war. So there are 3 major external exogenous shocks in the system, and also given the fact that we have higher for longer interest rates, longer due diligence processes, given the fact that you have to think in scenarios these days, what could be the potential impact of all these, or the outcome of these various impacts we are facing right now, right?
Mm-hmm. And I think that's probably the major issue that we have right now. The world has become pretty much unpredictable. So your exit of your asset in 3, 5, or 10 years is totally unpredictable from today's point of view. And because of that, not only more questions are asked during a due diligence process, but pretty much all questions there are being asked. And I think that's the reason why these processes are taking so long still.
So what people tell me is that this is a combination, because beside the fact that Jan, you mentioned, there was the whole ESG phase as well. Don't forget about that one. ESG came in, and everybody was like, okay, we need to now to look at the assets in a different way, and hence financing all of a sudden becomes more complicated because you need to have more data. How to bring the data in, who has to contribute, on all these questions that have been asked. And that is like in the whole environment, the global political environment, has made the asset class real estate per se far more complex than it used to be before.
But when we see a shift in transaction duration, or a decline, or a stagnation, what are the leading signals for you, or the leading reasons for that? Is it that the bid-ask spread is closing? Is it that debt markets, or the circumstances of debt and refinancing force investors to let go of assets? Is there even a stronger internationalization, that international investors seek opportunities in markets that are in a standstill? What are leading reasons for that, and how could they develop in the future?
So I think
I leave that to the specialists.
Mark, go ahead. I will follow.
I didn't actually.
Okay. So,
please go ahead.
So now, when I look, so we also did an annual survey with our European, also global investors, and the major headwinds, even the fact that the survey took place end of November, beginning of December last year, but the major headwinds for roughly 900 European investors was the ongoing mismatch in sell and buy expectations, and followed by the uncertain geopolitical landscape. Not so much interest rates, right? This is definitely also one thing we have to discuss or to keep in mind. So our house here at the moment is that we do not see interest rate hikes by the ECB or the Bank of England, but you have to look quite carefully these days on potential the variables and so on, given the fact that we have higher energy prices, crude oil, etc., etc. So, but there is still a mismatch. Yeah, we see that in some European markets, prime properties are fairly priced. Yeah, not overall, and especially in Germany, there's an ongoing mismatch between the buyer and seller expectations. Yeah.
Do you still see that? Why isn't there the correction coming? I mean, this is overdue, right? It's like
it is overdue.
Since many years we're discussing it, and my customers come towards me and say like, okay, you're gonna see next year there will be the gap's gonna be closing, and you're like, all right, so now this year on MIPIM it was like the fourth year in a row where people are telling me, yeah, but this year you're gonna see it's gonna be closing, but I'm not seeing it, and obviously. Neither the banks nor whoever is like really pushing to get that gap closed, and so for some that means like they need to be taking the loss, right?
I think on a global scale there are some markets that are quicker. Looking at the US, looking at the UK, where price corrections have been much more steep and much quicker, and I think these markets are the markets that are recovering the quickest as well. It's the German valuation system tends to be quite slow. So in your portfolio, I think revaluations take a time to become mark to market, and because of that, your seller and buyer expectation, the price gap is still quite large, and as long as there's no as long as the property is in your portfolio and there's no need to go to the market, as long as it's income producing and it's fine, then you're basically okay. And the valuation loss is just a thing on a paper and not realized. But when a thing like you have to refinance your asset, or you have or a tenant moves out, then things change, and that's I think just a slow process, but it will happen more and more.
In the last NPL webinar by Drooms, one of the participants raised, or several participants raised the assumption that there's an ongoing prolongation game between investors and banks, because neither of them has an interest in really putting that object or the property to the market. Banks fear of the customer not being able to repay the loan after they sell the property to fair market price, and the investor itself obviously doesn't want to take the cut. Is this gap, or is this prolongation game going to end soon? Is that one of the things that could drive the transaction market to gain speed again?
So we did this also an analysis in terms of the refinancing gap in Europe, and the biggest refinancing gap until 28 is in Germany, also given backed by offices. So, and I think my personally note and view is that this game will come to an end, given the fact that we have higher interest rates. Look what's happened to the swap rates over the last days. They went up by 40 bips compared to end of February. A 10-year government bond is at 3.1.
3.1, yes.
At the moment. So, in the risk premium, then you have to decide your own risk assessment of a property in a market XYZ. And then we have to discuss, is a risk premium of 100 or 150 bips fair, or do you need 200 bips? And then you end up 5%. And this is what we see at the moment. What is a good market price for an income producing asset? We do not talk about non-performing loans or non-performing assets. If you look at the EBA numbers, which was released yesterday by the European Banking Authority, the German banks, they have the highest NPL exposures in all Europe. with commercial real estate. So there will be more product from the banks, from investors who have to sell in the near future.
It's interesting what you say, because I hear this in 3 years, and so far nothing happened, and that's what surprises me, to be honest.
I think the prolongations by the bank are happening, year by year. Let's give the property 1 more year and see what the market does. And the market is not really changing, or it's changing too slowly. And the more this keeps going on, the more pressure is on the property and the banks. And I agree with you, Jan. I think that's going to come to an end. I think it's not going to be a stop. And like this year or next year, there's going to be tons of properties on the market, but it's going to be a slow process to work through.
And I think you hate this question, or you're gonna hate this question, but I'm gonna ask it anyway. When do you see the return to volume in the investment markets? Is there a timing or an assumption?
Depends on where you're looking, really. There's differences on a sector level, and there's differences on a country level. The UK is already recovering. The US is already recovering. Southern Europe is already recovering quite a bit. So that's kind of the geographic diversification. If you're looking at the asset level, at the sector level, there's a super high demand for data centers. Demand for senior living is going up. Just classic living, residential demand is pretty high. Hotels have seen a very good recovery recently. And then on the other end of the spectrum is like tertiary offices in the middle of nowhere, which are seeing pretty much no demand. So I think you have to differentiate more than you had to like 5 years ago, much more.
If you're talking about data centers, isn't that the next bubble?
I don't think so. Why? Look, all of us, we're talking about AI, and I guess this is also the next big thing we have to discuss. All of us are using, and we're talking about the digital transformation in the society, in our economy, and so forth. I think and this is also what our numbers are telling us, there is hardly any vacant space in the data center industry, in the FLAP-D market, plus the next top 5 markets. And this is the reason why a lot of investors are quite keen to invest in this asset class. And then we have to discuss, is it real estate or is it real asset? More infrastructure type of investment.
The risk I see there, Jan, is that demand for data centers is so high from all kinds of investors that there's just a risk of not enough knowledge to really understand what you're buying in. Other than that, I think the fundamentals are very sound, and just demand for data and storage and everything will keep going up in computing power. So I totally agree. The risk is more on the investor's side than on the fundamental asset side.
There's the energy risk as well, right? It's like
the
energy risk is massive, so not to underestimate. There could be the risk that all of a sudden we find ways on getting more computing power somewhere else, like in space. You have there's more than that risk, because imagine that these things are coming. I don't want to do Elon Musk here and send everything to space, but if that comes, something like this, we will see all over the place these wonderful areas, which we have then to look at. Maybe that's good for living then. No, but it's good that we have asset classes who are where is demand, where transactions are going on, and so this is what we see as well.
Yeah, or maybe there's also the risk of innovation. So next to sending those to space, these data centers to improve the productivity of data centers to a point where you don't need that much space. But future will tell, I guess. So let's have a look at the deal certainty. When we look at the survey Drooms conducted, a whole lot of investors stated that the deal certainty is declining, so 24%. A few more reported stagnation of deal certainty, but what could be the reasons for deal certainty to be declining? Is it still the bid-ask spread, or are there more reasons? I think, Mark, you stated investors are asking all the questions now. Is it that investors are trying to rather refrain from a deal than to take an uncalculated risk, and maybe we're more risk ready before the crisis, whenever that was?
I think that's to some extent the lesson learned of the last couple of years. Yes, become more cautious and really understand what you're doing. And also you have to differentiate between, the investment managers who really like to look at deals, but they have to secure the capital behind it. So the actual investors, like the big pension funds, you need to secure finance from the banks, etc. And those are the ones asking the questions as well. So there's a whole row of questions being asked. And I think securing finance for these deals, even though many of them are very attractive, that has become much more difficult. Allocations for many investors are pretty high, so they don't need to buy, everything that is on the market probably, and they're looking much more focused on what kind of property they actually want to execute on.
And they have to understand also the rationale of each selective investment. Yeah, not only to buy a market. Yeah, let's say CDX Germany as a safe haven. Yeah, you have really dig deeper and deeper to understand the micro-location, the quality of the asset, the quality of the tenants, the business model of the tenants. Yeah, will they survive if this ongoing turmoil is what we have? Also looking forward, what could impact have AI could has on such different businesses and different tenants in the building, etc., etc. Yeah.
Are you guys observing a shift in the preferred investment strategies of real estate investors over the last years? I think, Mark, you said that they are tending to be more defensive, or there are certain asset classes in the focus. And is there also a change in ticket sizes?
What we see is, Mark,
you go ahead. Yeah.
Okay. What we discussed already. So there's a clear shift towards every kind of living. Yeah, living for younger people, for couples. Yeah, senior, etc., etc. Student housing is up and coming, or purpose-built student accommodation. It's living. It's industrial and logistics, and surprisingly also offices. And then we see for some investors, they're also keen to invest in some kind of social infrastructure, like care homes, like medical office buildings. And yeah, you mentioned also the recovery of the hospitality sector. Hotels is doing quite well these days. Yeah, not only in Spain or in Portugal and Italy, but also in Germany. Yeah. Compared to last year's, compared to 24 investment volumes, hotels was the subsector with the strongest year-on-year growth. Yeah.
And I think you were also referring to kind of the risk profile investors are targeting and the ticket size. I don't think there's a massive shift to here and there. There's still enough capital looking for kind of value add opportunities as long as they're properly priced, which is the buyer and seller expectation gap again being there. There's capital there, but it's still kind of difficult to find this product, but it's happening. Clearly, there's more defensive buyers. Family offices have gone into like a gap that more institutional investors have opened them. So there's more family offices being active, more on the core end of the spectrum. And so I think on the risk side, there's still, activity on all ends. Just I personally find it difficult to buy a property that is exit driven when you really cannot predict the future, where your exit is happening like in 2 or 3 years. I personally find that quite difficult, but as long as the ingoing pricing is right, I think now is the time to find very good deals, maybe particularly on the office side where liquidity is so low. And in terms of ticket size, I mean, when capital and cost of finance was basically zero, so you got finance for free, then a lot of big ticket investments just happened. But that is much more difficult now. Banks again asking more questions, and the larger your investment, let's say it's a multi-sector city quarter with office, retail, residential, and a hotel, the more complexity you have, the more difficult it is to secure finance for that, or to find capital to do so. So those very complex and large deals are the ones that I think really have suffered and still do struggle and still have a difficult time.
To also give you a number, so just to interrupt, to give you a number. So last year across Europe, we tracked more than 9,600 transactions within CBRE. Yeah. So nowadays, the are close to 10,000 deals. Yeah. And almost 3,000 happened in the last quarter. And in Germany as well, we saw more deals, but smaller deals. And this is exactly what also in your survey was mentioned, that the sweet spot is around 20 to 50 million euros these days. But as I said, we are at the beginning of a gradual recovery also in Germany. So in the first 3 months this year, we have already 14 transactions above the 100 million euro mark. Yeah? And also to put this in context, last year in total, we have only 46 transactions above the threshold. So the market is back, but investors are quite cautious these days. Yeah, they dig deeper, they ask the right questions, and this will take time.
And this is exactly the point. I mean, if I look at the volumes of our data rooms, they have really significantly increased. I haven't been talking about the volume themselves. It's like really, it's like when an average transaction in the past, depends obviously the vertical you were in, but the average transaction is like between 10,000 and 30,000 pages. Now that has significantly increased, multiple 2, 3 sometimes, and so the activity, and that's the other thing that we're looking at, that we're watching, is really high. It's like when there is a transaction going on. I mean, that's not my publicity blog. It's like you need to have a very, 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 very reliable platform, because there's a lot of people working at the same time very intensively for hours and hours on the platform. And this is something which it's like before this webinar happened, we were quickly talking about 2008 and 2009, these years where we came from a situation where you could be selling everything before then the Lehman crash. And in those days, we had massive transactions with like not even half of the documentation that we have today. And today the transaction per se is lower, smaller. It should be faster. It isn't, obviously, but the volume, the volume of the documentation is still pretty high, and I'm very impressed by the granularity of the things. And then if you look at the Q&A, the amount of questions, we're not looking into it, but obviously we can track activity, is really, really high. So there's a lot of demand, a lot of questions being played forward and backward, a lot of parties involved. So that is something which has really changed. So what for me actually it's a good sign, because this seems to be a more professional approach towards the product itself, right? Because it's a little bit less cowboys, a little bit more people working really thoroughly. Very provocative, I know. Sorry.
Speaking of cowboys, I think we have to talk about the elephant in the room, in the Iran crisis, and possible outcomes for the real estate industry in Europe. Well, Iran has the thumb of one of the lifelines of the global economy, and they are pushing on that, which leads to rising energy costs, shortage of some supplies in Europe. Are there any developments you might observe now or you fear in the future arising from that conflict?
I mean, rates are going up. We have touched on that. So cost of finance is already moving, and that will or might have a negative impact, on volumes, at least in the short term. I'm not sure if this is a long-term issue, or if the market is a little bit overreacting and it will come down again. But just looking at the 10-year government bond yield, I mean, it's about 3%, and that's like a 15, 20-year high. It's quite substantial.
Yeah, the question is if this is, as you said, that a long-term thing. It's interesting if you look at after the Russian attack on the Ukraine happened, there was this reaction in the markets, but now everybody has taken it into account. The war is still ongoing, right? It's like they're still fighting. It's like 4 years now, and I don't think that this has changed anything. Now it's priced in, and people live with it. The question here is that such a fundamental problem which can become a global fundamental problem, that the whole worldwide economy is taken into hostage, that this had then a massive impact on the real estate market, and that is something, at least I don't think that I would be able to predict.
So as I said at the beginning of our webinar, our baseline economic outlook suggests that the real estate occupier markets, or the fundamentals there, will stay the course. But is it possible that the real estate capital markets could turn a bit more cautious, as Mark already mentioned, given also the fact that inflation rates are higher? There are potential discussions on increasing interest rate hikes, and the general uptick in uncertainty.
Given the pretty weak economy that at least Germany is in, what has been in the last 3 years, but still is in, weakening labor market, it seems very unlikely that the ECB could raise rates in the short term. I totally agree with you, Jan. That's not something I would expect. But what had happened? What we are seeing there, aside from the tragedy that a war is in general, just coming down to economics and everything. I mean, it is basically a continuation of what we've seen last year, which was pretty unpredictable the last year. And so this year began, again with a shock that clearly tells you where the markets will probably remain at least the next 3 years. They will remain unpredictable, and capital tends to go to, more predictable income in times like this, which could benefit real estate, which is more predictable in general than equity. And within real estate or infrastructure in particular, the residential side, again, is quite predictable when it comes to the income side. And I think that's why we are seeing so much interest, global interest in residential investments.
Yeah, and secure defensive asset classes, with a lack of decent supply, especially in Germany, with prime office properties, big box logistics in well-connected logistic hubs, student accommodation, I mentioned before, care facilities, medical office buildings, So there are plenty of opportunities. And this is the reason even that a lot of foreign investors also keen to invest in Europe, as so-called safe haven, and even Germany are on their radar. Also, given the fact that we, as the typical Germans, are quite cautious and not that optimistic on a recovery of our economy.
You gave some insight which markets you think are recovering in the near future, but as an opportunistic investor, I want to see which markets are recovering soon and are not on everybody's radar. So are there any markets that you look at with a certain interest where you might think they are undervalued or not valued properly by most of the investors out there? So who of you is smarter than the market?
So all of us, we're advisors, not not the investment managers.
I mean, as I think I touched on, the office market in some pockets seem undervalued at the moment. Even best product in the center of Berlin is kind of lacking to see sufficient capital of to be sold. They're like bidding like 15, 16, 70 times for a property that has been 35 times a couple of years back. There's so little liquidity in that space that when you really know what you're doing, I think there's some very good deals to be made in the office sector. But it's a bet. That's a risky bet.
Yeah, value add is quite interesting for logistics, every kind of logistics. Also going forward to think about the reconfiguration of global supply chains. And also in the living sector across Europe, or even also in Germany, value add investments in undersupplied regions with a strong population growth. This could also be a really interesting investment case, and it's worth to have a look at this type of investment markets, asset classes as well. We can't hear you.
Can't hear you.
Sorry.
I'm sorry. Just following trade publications over the last few months, I gained the impression that there's a rising interest in Eastern Europe among Western European investors. Is that something that you see as well, or is that something that is more of a trendy topic to discuss, but is not really gaining traction in the market? And after that, we have a little question from Frank.
Can only answer these questions with our investor intention survey. So Poland, for example, was ranked on position 5, slightly, on position 3, sorry, in terms of investors' interest for investments in various asset classes in that market. And also Germany is only ranked on position 5. This gives you some impression that investors also are looking to markets in Eastern Europe and not so much in the core markets. Yeah.
All right. Frank asks if we have to accept that the entire market is smaller than before and we've had a kind of oversupply. For him, it is kind of the new normal. We have to live with a reduced volume of transaction. Windfall profits are gone, and professional players are needed, and income-producing assets are more asked than before. German industry is facing substantial problems, either by regulation, cost of energy, and problems with infrastructure. I can't see stimulation and real change to solve these problems. Governmental funding program isn't secured and nobody knows how long which program will last. Uncertainty is a dominating element. Mark, this is your key word.
It was a complex question, though.
I think just to reduce it to the core, it's the question is the circumstances we have now in the market, is that the new normal for the near or far future? And the things we experience in the last 10 years, in the last decade, those were circumstances that were not at all normal.
Yes and no. Also, I don't think that this is the new normal. But I also don't think that, the years 2018 to 2021 have been normal. So, the normal is somewhere in between. The normal is somewhere that we're seeing like 25, 30 billion, probably a little more of transaction volume in Germany. So it will gradually get back up there. We're still at a very, very low point, even from a historical point of view, not just when it comes to volumes, but also the number of transactions. Even though they're going up here and there, they're still far below what we've seen in the past. And in my point of view, that will come back, yes. Markets are just cyclical. We'll cover.
Yeah, and Alex, anything to add on that?
It's also a question, what was the investment volume? So do we compare 26 or 25 with 21, with an all-time high of more than 100 billion euros invested in Germany, with an interest rate environment in nominal terms sub-zero, in real terms -2%. I think that was a bit an outlier, and this is what I think we've come back to a normalization and polarization in the market. So our forecast, given the fact that we will have 8 billion euros, and given also our baseline scenario that we will have more clarity around the current geopolitical environment and so on. So then our expectation is that we will have 5 up to 10% more investment volume in Germany than last year. And you end up at 35 up to 40 billion euros in 26. So this is my current base case scenario for Germany. Yeah. I think, which is realistic.
You said base or best case?
Yeah, best is 40, base is 35.
Okay.
At the moment, as we speak. Also, to bear in mind that markets are quite, and the circumstances are highly fluid and uncertain.
I can only say that from our point of view, and I'm not coming from the same direction as the two guys here. It's like there's volume coming back. There is quite some interest. There's quite some demand. We are opening a lot of data rooms every day, which is a good sign. We have from smaller to bigger assets, from even some portfolios. Unfortunately, I cannot disclose more. And but the thing is, there is activity that we see. So I want to end this here on a more positive note, because sometimes we get the impression now that the world is going down, and one can have the impression when reading the newspaper every day. But the thing is, there's obviously capital, and there's obviously product. And do they find the way towards Germany, towards our market? Maybe not always, but there's activity, and activity is always a good sign. And when there's activity and people are working seriously, there must be, and this is my take. It's like, I don't want to be negative. I don't want to be destructive. For me, it's like, we even though a lot of people tell me what are the signs which make you believe that something is changing. Well, I believe that human behavior is making things change, and we see a lot of activity. So it's not that it's completely dead, that everybody is in depression. There are some who are not very well, and there are others who are like, no, we're looking at the things, we're looking at good opportunities, and we'll find good opportunities, because we want to stay in that real estate market. We want to find the right asset to buy, and that's a good sign. That's a good way.
Just to wrap things up, looking forward a year from now, or one real estate transaction from now, as the trend report suggests, what do you think? Will we see a further decline or stagnation of the transaction duration, or have we reached a so-called baseline that is just as one of our participants called it, new normal for the market?
The duration. Let's come from another side. We are getting more and more tools which help us getting more transparency faster. In a globally more and more complex world, this is essential. So my strong belief is the transaction time, the due diligence time will shorten, even though the complexity will not move away. But with the tool that we have in place, we will come to conclusions much faster, and then we can take hopefully good decisions. And therefore, my take for 2026 is that the duration is going shorter. Jan, Mark, you guys.
I don't have anything to add there, Alex. No, I just agree.
I'm a big fan of data, and to use data quite efficiently. And as you said, data will help, and also all the AI tools in place, also at CBRE, will help to have better and faster decisions. And this will also drive, hopefully, the investment market. And as I said, investors are not only at the sideline, they're quite active. At the moment, 10% more investment volume than last year at the same time. So I think it's, and as just mentioned before, we are in the midst of a gradual recovery.
Just towards the end of our webinar, there was another question. Do you think that major part of investors have accepted the price adjustment of their portfolios and are willing and able to sell at current yields now more in the area of 5% instead of former 3%?
Not all of them. Definitely not.
Yeah, I think this pinpoints to the problem we pointed out earlier. If the major part of investors would have accepted the price adjustment,
exactly. And we had especially Germany, as we talk about the German yields here, a former free or even for prime offices in Munich net was 2.5% at the peak of the market, the peak of the last cycle. Yeah.
It was the most expensive market in Europe, right?
Yeah.
Nothing was more expensive than Munich offices from a yield perspective.
Zurich.
And this is
total different market. Sorry, just now you're frozen, I think.
So then I'm going to take over from him. There's another question. Hi, everyone. I'm looking for some current insight on the German residential market. Where are you currently seeing prime yields multipliers for core resi assets in the top 7? Also, what's the sentiment regarding forward deals right now? I see an increasing appetite from certain investors. Resi, Germany.
Resi Germany at the moment, prime, really prime, newly built, 3.4% roughly on average. Existing stock 100 bips higher.
You agree, Mark?
I do agree. Although we're not really tracking, the prime yields, but more like the average yield, average multipliers, and they are more like 5%. And in the top 7, maybe 4.5.
If you're interested in more details, just reach out to Mark and Jan.
Let's do so.
They have plenty of numbers to crunch with you, I guess. We reached the end of our today's webinar. So thank you everybody for being here. If you're interested in any further information, just reach out to Alex, Mark, Jan, or myself. Social media, LinkedIn, email, whatever, and we are happy to help and to provide you with any information we can on our topic today, on the real estate trends by Drooms, or investment survey by CBRE, or the risk yield
risk and return ranking?
Yes, risk and return ranking. Thank you, Mark, by Lübke and Kelber. So there's some interesting reads. So just reach out and contact us. Other than that, it's left to say thank you, everybody, for joining. Thank you, Alex. Thank you, Mark. And thank you, Jan, for being here and for having me. Thank you.
Thank you very much.
Thank you a lot.
Thank you.
Thank you.
Bye-bye.
Have a nice day,
All the best.
everybody.
And
Cheers.
you. Bye-bye. Bye-bye.